The phrase zero-sum game is popular as it transforms economics and capital into a simpler, binary concept where, if one investor loses, another gains. But is this true? One way of looking at this is to ask where all the money, or to be more accurate, currency, goes when the stock market crashes. In other words, if economics is a zero-sum game, then how does the expansion of capital confound this assertion? The concept of economics as being a zero-sum game is often attributed to the 19th century economist Vilfredo Pareto, who argued that economic transactions involve a fixed pie. However, the expansion of capital can confound this assertion in several ways. First, when central banks create currency to inject into the economy or to lend to governments and banks, they often do so by creating new money that previously did not exist, just as banks lending to companies or home mortgagees do. So central banks can inflate the amount of currency in circulation and thus stimulate economic growth, just so long as the supply of currency does not outpace the growth in material demand, which is, of course, inflationary. In theory, a company listed on the stock market is classically priced according to its earnings per share, multiplied by the number of shares issued. However, the price-to-earnings ratio may be manifold higher than the company's actual annual turnover, just as the price reached at auction for a painting may be many times its predicted valuation. So we could argue that many companies are irrationally priced at many times their actual revenue generation. There is a metric, the Buffett indicator, which divides the actual value of all the stocks on the market by the entire country's gross domestic product, or GDP. The Buffett indicator is currently 200% of GDP, which also includes small businesses and government spending, which are not factored into the stock market. In a bull market, the stock market's wealth in terms of currency valuation is inflated by sentiment and the injection of new central bank currency into the market, whereas, when there is a collapse or bear market, this hot air is simply dissipated as these currency earnings never existed in the first place. From a classical economic standpoint, the expansion of capital can lead to economic growth, which means that the overall size of the economic pie increases. This growth can create new opportunities, jobs, and wealth, allowing multiple individuals to benefit simultaneously. In this scenario, the expansion of capital is not a zero-sum game, as the pie grows, and everyone can, in theory, benefit. For instance, the expansion of the technology sector has created new industries, jobs, and wealth, benefiting not only entrepreneurs and investors but also the broader economy. Capital expansion can lead to increased productivity and efficiency, as new technologies, machines, and processes are developed. This can result in higher output and lower costs, making it possible for businesses to produce more goods and services while reducing waste and inefficiencies. This, in turn, can lead to increased economic growth and prosperity for all beneficiaries. For example, the development of automation and robotics has increased productivity in manufacturing, allowing companies to produce more goods with fewer resources and reducing the need for manual labor. New markets and industries can be created by the expansion of capital, such as the genesis of the internet and e-commerce. This expansion of capital has created new winners, rather than simply redistributing existing wealth, even though its successful exponents like Jeff Bezos and Jack Ma became billionaires as small retail outlets failed. Increased competition can drive innovation, improve quality, and reduce prices, thereby increasing the effective wealth of consumers and businesses. For instance, the rise of ride-sharing services like Uber has increased competition in the transportation industry, leading to lower prices and more affordable journeys. The expansion of capital can lead to greater diversification and specialization, and thus comparative advantages. For example, the growth of digital finance has led to the creation of new job opportunities, while social media has created an industry of influencers and drop-shipping retailers. The expansion of capital can also lead to the development of human capital, as individuals invest in education, training, and skills development. This can increase their earning potential, job prospects, and overall well-being, creating a positive feedback loop that benefits individuals and society as a whole. Increased economic mobility enables individuals to have more opportunities to start their own businesses, invest in new ventures, or switch careers, creating a more dynamic, diversified, and adaptable economy. Improvements in healthcare, education, and infrastructure, affected by increasing investment, can improve productivity per hour worked and reduce the drag of healthcare costs and sick days, while capital injection in AI and automation can further increase productivity and earnings. Yet there is a caveat, as the printing of currency without a corresponding expansion of underlying assets can asymmetrically skew wealth distribution. This is because, when a central bank prints more money without a corresponding increase in economic production, this leads to asset price inflation, which benefits those who hold assets and punishes those who do not and who have only earnings and cash savings. Thus, the printing of money without a corresponding increase in assets and economic productivity, either through the release of more currency into the economy or the provision of more debt, can lead to a wealth redistribution, where the benefits of the increased money supply go to those who already hold assets, such as the wealthy and large corporations, rather than being evenly distributed throughout the economy. The lack of any corresponding increase in assets can also lead to uncertainty and instability in the economy, as the increased money supply can create artificial bubbles and distortions in the market which can disappear as readily as they appeared through quantitative tightening, the repossession of assets due to bankruptcy, or the repayment of debts, which effectively removes currency from the economy. While the printing of currency without a corresponding expansion of underlying assets can create an uneven playing field, where some individuals and groups benefit at the expense of others, the economic pie is neither static nor proportional to actual economic activity, and slices can expand or disappear as they are hypothetically distributed. When money is created, the economic pie does not necessarily increase in linear proportion to the injection of capital, and one man's loss or gain does not always occur at the expense of another. For instance, if a new company calls 1 million shares into existence when it is formed, this does not occur at the expense of another account. In summary, wealth can both be created out of thin air, as well as destroyed by central banks, wars, market crashes, and the reduced productivity caused by strikes, pandemics, and the abrupt ending of the lending and printing cycle. Thus, economics is not a zero-sum game.